My name is Rhiley Langworthy, and this presentation will look at the effects of the Tax Cuts and Jobs Act of 2017. The idea of an income tax was not something of which the Founding Fathers approved in writing the Constitution, so they created a system that provided federal funding through consumption taxes, what people purchased, rather than on income. The 16th Amendment was passed in 1913 to allow some of the financial burden to shift from lower income individuals towards big businesses and the wealthy, who could afford to pay more in taxes than the lower income individuals. Since then, many laws have been passed to regulate this delicate balance of taxes and prevent abuses. The Tax Cuts and Jobs Act of 2017 had a similar goal, to shift some of the financial burden off lower income individuals, but also to stimulate the economy and help businesses at the same time. This had major effects on accounting and finances for the following years, some that were expected and others that were not. The act is not set to expire completely until 2025, meaning there are still unforeseen outcomes to be realized. The Tax Cuts and Jobs Act is the first major overhaul to the tax system since 1986. It is common for tax laws to change each year to accommodate societal changes as well as changes in economic goals. However, significant overhauls are quite rare. The provisions for individual taxes in this act are set to expire completely after 2025 to coincide with Senate budget rules. It is unclear if the act will be extended or made permanent, but if it is allowed to expire, the tax system will completely revert back to the pre-Tax Cuts and Jobs Act form. The main goal of the Tax Cuts and Jobs Act was to stimulate the economy. The new law made substantial changes to the rates and bases for both individual and corporate income taxes. The interesting part about this law is that it was designed to cut federal revenues by significant amounts, with plans to make up for that with an expected economic growth in the U.S. However, the law could expire before this growth can occur. The Tax Cuts and Jobs Act lowered most individual tax rates and modified the widths of the tax brackets for those rates. The law kept the 7-bracket structure but made it much simpler. This means that most individuals pay less in their weekly taxes and receive more in their weekly paychecks, resulting in a lower tax refund at the end of the year. The Tax Cuts and Jobs Act indexes these brackets by the changed CPI or Consumer Price Index measure of inflation, resulting in smaller upward adjustments each year, but the initial adjustment was large. This significantly increased the standard deduction or the reduction for what you owe in taxes for individuals. This means fewer people are itemizing deductions, which is time-consuming for taxpayers. The Tax Cuts and Jobs Act increased the child tax credit from $1,000 to $2,000, of which the first $1,400 is refundable to the taxpayer with no tax liability, and created a new $500 credit for other dependents. The phase-out limit for the child tax credit was also increased for single filers and joint filers. This allowed a lot more people to receive credits for their children as well as other dependents in their home and get more money back on their returns. Taxpayers with children who had a 529 college savings plan also received the added benefit of being allowed to use savings from the plan for education expenses other than college, where previously they could only use the savings in the plan for college education expenses. As of January 1st, 2019, the Tax Cuts and Jobs Act was able to effectively repeal the individual mandate penalty for health insurance by lowering the penalty amount to $0. The benefit of this is that the low-income individuals who could not afford insurance were no longer being penalized and forced to pay a fine for not being able to afford health insurance. Prior to the Tax Cuts and Jobs Act, taxpayers who inherited property that was valued at more than $5.49 million were responsible for a 40% tax rate. The law increased that amount to $11.18 million in 2018 and $11.58 million in 2020. The Tax Cuts and Jobs Act also allowed taxpayers who itemize their deductions to deduct up to 60% of their income for charitable donation. This motivates people to give back a lot more. On the other hand, the Tax Cuts and Jobs Act eliminated the personal and dependent exemptions in 2018 that would have amounted to $4,150 for each taxpayer, spouse, and eligible dependent. Homeowners with large mortgages are at a disadvantage from the Tax Cuts and Jobs Act because the law lowered the maximum mortgage interest deduction from $1 million to $750,000, still requiring the taxpayer to itemize their deductions. The Tax Cuts and Jobs Act also removed the allowance to deduct up to $100,000 in interest paid on a taxpayer's mortgage loan. Furthermore, the law also limited the deduction for state and local income, sales, and property taxes to $10,000 combined. This was especially impactful on individuals living or working in states with high tax rates such as California and New York, which as of 2021 is once again the highest tax state. The Tax Cuts and Jobs Act eliminated the individual mandate for health insurance, which could result in fewer individuals having health insurance in following years. The law removed many other deductions that taxpayers would have been allowed to take, such as writing off miscellaneous work expenses, unreimbursed employee expenses, employer-subsidized parking and transportation reimbursement, casualty and theft losses, tax preparation expenses, alimony expenses, and moving expenses. There is also a limit on what could be deducted for medical expenses from this law that could negatively impact individuals with high annual medical expenses. And although the law increased the allowance for charitable contributions, and an overall increase can be seen in the amount of charitable donations, the percent of American households that do donate has been declining in recent years. After extensive research into how different households would be affected by the Tax Cuts and Jobs Act, I found that most of the working class, low-income households would receive more tax breaks and a greater benefit from the reform. Some middle class and high-income households would have less of a tax break but could be compensated by the charitable contribution deduction as well as other deductions with increased limits and phase-out limits. The economic impact that this law could have for low-income households could allow for major economic growth for those individuals, eventually raising their tax bracket and contributing more to federal taxes in the future. If this law is allowed to completely expire before the growth can happen, then the law might not be as effective as it is designed to be. Also, increased taxes for high-income households could allow the government to redistribute funds in ways that stimulate growth for businesses. I did not investigate the effects of the Tax Cuts and Jobs Act on businesses, but from crossover information, it seems that many tax breaks were instituted for businesses in this reform as well.